Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research at the University of Buckingham. This is the latest monthly update on the global monetary scene. It's August 2018 and a quiet time with many people away on holiday, so I thought that I might talk about something very general, and I want to look back, in fact, to the whole period in the American economy since the 1960s. But in order to understand why I'm doing this piece of work, I think we should notice that many people are puzzled about the resilience and durability of the current period of economic growth. Of course, there was the Great Recession in 2008 and 2009, the recovery of 2010, and then since then growth has been very steady, very moderate, non-inflationary, in a sense marvellous, and surely it has to stop sometime. Surely there must be some bust or trouble or recession out there, or perhaps not. And what I want to do today is to recall one of the most bitter debates in economics, a debate between the Keynesians and the Monetarists. And I'm going to bring in two of the champions on both sides of this debate. I'm going to bring in Paul Krugman, the noted columnist on the New York Times, a Nobel laureate, and many people would see him as the world's most distinguished Keynesian economist. And then I'm going to bring in Milton Friedman, who died in 2006, but who remains very much, in my view, an influence on what happens today and the way we think about economics. Now, the Keynesians believe in the economy is unstable because there's all these business people have got animal spirits, and sometimes they invest too much, sometimes they invest too little, and the economy goes up and down because of this instability in the private sector, and it's the job of the government to stabilize things through its government spending, through changes in taxes perhaps, through fiscal policy, through changes in government spending and taxes. What Milton Friedman advocated, on the other hand, was that the key to economic stability is steady growth of the quantity of money, and he despised fiscal policy. He said fiscal policy base doesn't work, has no clear relationship with the behaviour of aggregate demand, and so on. And in this debate, just to get things clear, to end your suspense, I'm very much on Milton Friedman's side. Now, shortly after Friedman died, there was a rather critical article in the New York Review of Books by Krugman of Friedman, and then some years later, which itself caused some debate, following up that earlier comment, there was a blog, an opinion piece in the New York Times by Paul Krugman with, to my mind, a rather aggressive title, Milton Friedman, Unperson. Can be much harsher than that. And he had a go at Friedman's advocacy of stable money growth. And even if you give him a pass on the 3% growth of M2 thing, which was abandoned by almost everyone long ago, Friedman was still very much associated with the notion that the Fed can control the money supply. In the wake of the 2008 crisis, this looks wrong from soup to nuts. I'm not quite sure what that means, but still, the Fed can't even control raw money. A few decades from now, historians of economic thought will regard Friedman as little more than an extended footnote. Okay. Now, Friedman did believe in the monetary theory of national income. He did believe that over the long run there is a relationship between the rate of change of the quantity of money and the rate of change of nominal national income. And he thought that changes in the velocity of circulation of money were small relative to these movements in money and nominal GDP. He did concede that with some concepts of money, there might be a rising ratio of money to national income as people became richer. and as they became more accustomed, they had more financial assets, they needed more money balances relative to their income. But on the whole, he would expect the rate of growth of national income to be equal to, very similar to at least, the rate of growth of the quantity of money. Obviously, the implied recommendation to policymakers is keep money growth stable. Avoid big ups and downs in the rate of growth, the quantity of money. And of course, you then get into all this analysis of banking systems that we do at the Institute of International Monetary Research, because the main type of money in the modern economy is bank deposits. Now, Friedman expressed these ideas in various places, but the first kind of consolidated statement was in some lectures given at the Fordham University in New York in 1959 and brought together in a book published in 1960, a book called A Program for Monetary Stability. And I'm just going to quote from this book. You might say, well, it's 58 years ago now, why are we still interested in this? Well, you just wait till I show you what's happening today, what's happened the last 7 years, and you may be astonished at just how relevant Friedman's remarks remain, in my view. Friedman said that his preferred policy rule was the stock of money should be increased at a fixed rate year in and year out without any variation in the rate of increase to meet cyclical needs. No. Don't try and stoke up a boom by increasing the rate of monetary growth. Okay, just keep it low, steady. He conceded that there was ambiguity in the notion of the quantity of money, and he said in our own research, this research with Anna Schwartz, we have found that the most useful concept to be the one that includes currency held by the public, plus demand deposits, plus time deposits at the commercial banks, all deposits including time deposits with the commercial banks. In other words, Milton Friedman favoured a broadly defined concept of money as the one relevant to the conduct of policy and in understanding movements in national income. He went on to say the rate of increase in the quantity of money should be chosen so that on average, it could be expected to correspond with a roughly stable long-run level of final product prices. For the concept of money just recommended, namely currency plus all commercial bank deposits, broad money, this would have required a rate of growth of slightly over 4% per year on average over the past 90 years. Something over 3% to allow for the growth of output, and 1% to allow for the secular decrease in velocity. This is this business of people having a bit more money relative to their incomes. As they become wealthy, they have more financial assets, they become more financially sophisticated, and so on, that 1%. To judge from this evidence, a rate of increase of 3% to 5% per year might be expected to correspond with a roughly stable price level for this particular concept of money, broad money. Okay, now what I've done is to look at this book came out just as the Federal Reserve was refining the preparation of money supply data, and we have good, reliable money data on a monthly basis going back, in fact, to 1959. And what I've done in this chart is to compare the rate of increase of the quantity of money, as just defined by Friedman, with his 4% recommended rule. That's the red line you can see there, just slicing through the bottom of the chart. Well, sadly, the Federal Reserve, I'm afraid, and the American government and American policymakers in general did not, on the whole, observe Milton Friedman's rule in this period. You can see that in the 1960s, money growth was somewhat higher than that. In the 1970s, appreciably higher than that. America had an inflation problem, exactly as you'd expect. There was then efforts to reduce the rate of monetary growth. Inflation did come down, and then we've had quite a lot of volatility recently, particularly, as I pointed out in my work, this huge jump and then collapse in money growth in the USA at the time of the Great Recession. So policymakers didn't follow Friedman's rule. First thing you might need to know is Friedman said back in 1960, 1959, 1960, that he'd expect, roughly speaking, that money, the way he just defined it, would rise about 1% a year faster in the medium and long run than nominal national income. What happened in this period? The answer is that the average annual percent rate of increase in M3 in that 58-year period, 1960 to 2018, was 7.4%. And do you know, the average annual percent rate of increase in nominal GDP was 6.5%. Not 1%, but 0.9%. Bang on. When you look at the fluctuations in money in this period, sometimes money doesn't help, or sometimes doesn't give you the right feel for things. I concede that. There's a funny period, the early 1990s, when money growth was curiously low. There was a recession in the early 1990s. There was a fall in inflation in the early 1990s. But I'm afraid that it's very difficult to relate what happened then exactly to what was happening to the rest of the economy. Money growth was peculiarly and inexplicably low. But then you look, say, at the Great Recession, and you see this surge in money, this collapse in money, fits in with the monetary theory of national income determination, yeah? What I want you to notice now is perhaps a surprise. You know, it's this joke about if you had a monkey and it was given a typewriter and it just had tens of millions of years, eventually it would type out Shakespeare. Just because sooner or later. Well, the Federal Reserve finally, in the last 7 years, hasn't said it's doing it, but it's actually complied with the rule that Friedman recommended back in 1959. It has had a period of 7 years in which the average growth rate of money has been 4%, in fact 4.05%, slightly above 4%, without much fluctuation. It's actually complied with Friedman's rule. What's happened to the economy? Well, if you believe Paul Krugman, he would say that it doesn't really matter what happens to the quantity of money. You know, that you wouldn't expect this period of low and stable money growth to be associated with anything in particular. Well, let me tell you, what's happened is that 7-year period has seen the most stable growth of nominal GDP in that entire 58-60-year period. And it's also seen the lowest inflation. Friedman was right. Okay? Much despised, much abused, Milton Friedman was right. Long last, there's been a 7-year period of low and stable money growth. There's been very low inflation. There's been a stable economy. What does this mean for the future? I remain worried that the Federal Reserve, which at the moment is selling off some of the assets acquired in the QE programs of the 10 years ago, that it may overdo this and cause too sharp a reduction in money growth. But for the moment, things in America are fine. If money growth remains between 3% and 5% at an annual rate over the next few years, there is no reason to expect a boom, a bust, a recession, any great instability. There will be a continuation of steady growth with low inflation. Milton Friedman was right. And Paul Krugman, I'm afraid, has got it all wrong. And there's no way, Professor Krugman, that Milton Friedman is an unperson. Thank you.